The Graham Formula, your blueprint for smart stock selection. Imagine if you had a secret formula, a blueprint that could guide you to consistently choose the best stocks and build wealth. What if this formula could unlock the potential to transform your financial future? Stay with us, and we'll reveal the Graham Formula, a powerful tool for smart stock selection, and show you how to apply it for lasting success. Welcome to Nouveau Riche Investor. Today, we're diving into the Graham Formula for stock selection. We'll explore its origins, break down its components, and demonstrate how you can use it to make informed investment decisions. Benjamin Graham, known as the father of value investing, introduced the Graham Formula in his seminal work, The Intelligent Investor. This formula has guided countless investors, including Warren Buffett, to make sound stock choices based on intrinsic value rather than market speculation. The Graham Formula is a straightforward mathematical equation that helps investors determine the intrinsic value of a stock. It's designed to identify stocks that are undervalued by the market, providing a margin of safety for investors. The formula is simple yet powerful. Intrinsic value equals the earnings per share, EPS, multiplied by 8.5 plus 2 times the expected annual growth rate, G. This equation allows investors to quantify the value of a stock based on its earnings and growth potential. Let's break down each component. Earnings per share. This is the company's profit divided by the number of outstanding shares. It's a measure of a company's profitability on a per-share basis. 8.5. This is a constant that Graham considered the appropriate price-to-earnings ratio for a no-growth company. 2G. This represents twice the expected annual growth rate of the company. It accounts for the company's future growth potential. Now, let's apply the Graham Formula to a real-world example. Suppose we have a company with an EPS of $5 and an expected annual growth rate of 6%. Plugging these numbers into the formula, this is we get. If the current market price of the stock is below $102.5, it might be undervalued and a good investment opportunity. By using the Graham Formula, investors can systematically evaluate stocks and identify those that are trading below their intrinsic value. This disciplined approach reduces the risk of speculation and focuses on long-term value creation. The Graham Formula is more than just a tool, it's a mindset. It encourages investors to look beyond market fluctuations and focus on the fundamental value of a company. By applying this formula, you can make informed investment decisions and build a portfolio that stands the test of time. In conclusion, the Graham Formula is a timeless blueprint for smart stock selection. It's about making informed choices based on intrinsic value, maintaining discipline, and having the patience to see your investments grow. Follow these principles, and you'll be well on your way to financial success. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.